Imagine possessing a powerful secret, the ability to give generously, maybe to family or the causes closest to your heart, and in doing so, significantly cut your tax burden.
Oh,
What if, every act of generosity could also be a smart financial move? Today, we're unlocking precisely that. The strategic secrets of U.S. gift and charitable giving tax rules. These don't just minimize your taxes, they can actually amplify your impact.
exactly. That's really our mission today. We want to equip you with the essential insights from this pretty complex material. The goal is that you walk away not just understanding the rules, but knowing how to apply them for maximum financial benefit.
Right.
This deep dive is all about transforming your generosity into powerful tax-saving strategies, helping you become, well, truly well-informed to make smarter financial decisions that directly put more money back where it belongs, with you, your loved ones, or your chosen causes.
So we're going to unpack the U.S. federal gift tax system, right? We'll dissect its various exclusions, the ones you can use every year, and those truly unlimited ones. And then we'll pivot to the incredible opportunities presented by strategic charitable donations.
That's the plan.
Our entire focus is showing you how to navigate this landscape, identify the critical distinctions, and leverage every rule to transfer wealth and support charity in the most tax-efficient way possible. Okay, let's unpack this then. Before we jump into the exciting world of tax savings, we really need to understand the fundamental architecture we're operating within. What exactly are we dealing with when it comes to the federal gift tax system here in the U.S.?
Well, the U.S. employs what's known as a unified transfer tax system. That term is really crucial because it means the federal gift tax, which applies to transfers you make during your lifetime, and the estate tax, which applies at your death, are, well, they're integrated.
Integrated, okay.
Think of it not as two separate taxes, but more like one overarching system. It keeps a running tally, of all significant wealth transfers you make throughout your life and then also at death. So every taxable transfer you make, whether it's a gift today or an inheritance later, it counts towards this single cumulative total.
It's like a lifetime scorecard. Everything goes into one big bucket, sort of building up over the decades.
Exactly. And against this cumulative total, every individual has something called a unified credit. Sometimes you'll hear it called an applicable credit. This credit is incredibly important because it allows a really substantial amount of your cumulative taxable transfers to pass free of tax, both during your lifetime and at your death.
How substantial are we talking?
For 2023, this credit effectively shelters cumulative taxable transfers up to $12,920,000. That's a significant number, right? And it represents the total amount you can transfer across your lifetime and at death before the actual unified transfer tax starts to kick in. It's sort of your long-term planning horizon for any substantial wealth transfer.
That's definitely a reassuringly large number for many people. Puts a lot of minds at ease about passing on wealth. But for the average listener, it's really crucial to understand what actually counts as a gift in the eyes of the IRS. It's not just like a birthday check, is it? What exactly is a taxable gift?
You're right. It's much broader than just a simple cash transfer. The IRS defines a taxable gift as any transfer of money or property. And this covers everything, real estate, personal possessions like jewelry or art, even intangible assets like stocks, bonds, or intellectual property rights for less than adequate or full consideration.
Ah, okay. Less than adequate or full consideration. That sounds key.
That phrase is the absolute key differentiator. If you sell your car to a stranger at fair market value, well, that's a fair exchange, not a gift. But if you sell that same car to your child for, say, $1, or if you transfer shares of Stank to a friend without getting anything of comparable value back, the difference between the fair market value of what you gave and what you actually received back, that difference is considered a gift. It's really about what you didn't get in return.
Okay, this is where it gets really interesting for everyday generosity, the annual exclusion. This sounds like a foundational, powerful tax-saving strategy that maybe a lot of people don't fully leverage. And it's something almost anyone can use without even touching that huge lifetime exclusion amount, right? Something like your annual superpower for giving.
Absolutely. It's incredibly powerful. The annual exclusion allows you to exclude the first $17,000 of gifts made to each done in a calendar year for 2023. This is a critical distinction. It's not $17,000 total per year from you.
Right.
It's $17,000 per recipient per year. So if you have, say, 3 children, you can give each of them $17,000 tax-free. That means $51,000 can be moved out of your estate without using any of your unified credit.
Wow.
And a common misconception is that you need to file a gift tax return for any gift. The great news is, if your gifts to any one person stay under the $17,000 annual exclusion, you typically don't even need to file a gift tax return. Makes it incredibly simple and efficient for regular wealth transfer.
And if you're married, this gets even better, right? It turns into an even bigger opportunity.
Yes. This is where gift splitting truly shines. If you and your spouse are married and you elect to split gifts, any gift made by either one of you can be treated as if it were made one half by each of you.
Wow.
This effectively doubles the annual exclusion to a generous $34,000 per dunny. Think about that.
Yeah.
A married couple could give each of their 3 children $34,000, that's $102,000 total, out of their estate completely tax-free every single year without touching any of their lifetime unified credit.
That's huge.
It's a monumental opportunity for couples looking to systematically transfer significant wealth to multiple people over time without any immediate tax implications or, paperwork, as long as each individual gift stays below that doubled exclusion amount.
That truly sounds like a game changer for so many families. It's almost like having a clear path to make regular, significant contributions to loved ones' financial well-being without a tax penalty. But, with taxes, there's always a catch, isn't there? You mentioned a crucial caveat earlier. This annual exclusion isn't available for a future interest gift. We definitely need to dig into that distinction. Sounds like a common pitfall.
We certainly will, and it is a common area of confusion. But hold on, before we get there, let's highlight an even more powerful concept. Beyond the annual exclusion, there are specific scenarios where you can give away unlimited amounts of money without incurring gift tax at all. Unlimited. These aren't just minor deductions. These are truly game-changing for strategic giving, especially for things like helping family, covering medical care, or major charitable efforts. The IRS has carved out these specific unlimited exclusions for certain types of transfers, often because they serve, broader societal benefits, or maybe they're not really viewed as traditional wealth transfers someone might try to exploit for tax avoidance. The first key category is direct payments for education. Any amounts paid directly to an educational organization for a DUNS tuition get an unlimited exclusion from gift tax.
Okay, directly to the school, not the student.
That's the absolute critical condition here: tuition and directly to the institution. You cannot give the money to your grandchild and then they pay their tuition. You must pay the college or university directly. And remember, this exclusion is strictly for tuition. It doesn't cover living expenses, books, room and board, or other payments made to the student. Those payments would fall under the annual exclusion if they don't exceed it. That distinction is vital for anyone helping with college costs.
That's a huge strategic insight for anyone funding higher education for family. You could pay for a whole degree, even med school, without touching your unified credit.
Exactly. And similarly, there's an unlimited exclusion for direct payments for medical care. Fees paid directly to a healthcare provider for a Denise medical care also get an unlimited exclusion.
Same principle. Pay the provider directly.
Exactly the same principle. Directly to the provider is critical. This means you can pay your friend's hospital bill, your parents' nursing home fees, maybe even a specialized medical treatment directly to the institution or doctor without it counting as a taxable gift, no matter the amount. But just like with education, if you give the money to your friend and they pay the bill, well, that counts as a gift subject to the annual exclusion. It's a subtle but really powerful difference in how you structure the payment.
And then, of course, the big one for many who are charitably inclined, gifts to qualified charities.
Yes, charitable gifts also have an unlimited exclusion from gift tax. If you make a gift to a qualified charitable organization, and we'll define qualified more thoroughly later when we talk income tax, there's absolutely no limit on the amount you can give without incurring gift tax. This means large donations, even multi-million-dollar ones, don't trigger a gift tax liability on your end. Now, we'll get into the income tax deductions for these later, but for gift tax purposes, unlimited.
And finally, a really substantial one for families and estate planning, transfers between spouses.
Indeed. Transfers between spouses are allowed an unlimited exclusion from gift tax. This is famously known as the marital deduction, and it's really a cornerstone of estate planning. It's specifically designed to let spouses transfer wealth freely between each other, either during their lifetimes or at death, without triggering any federal gift or estate tax. It allows for flexible financial management within a marriage. However, there's an important nuance here. To qualify for this marital deduction, there generally can't be a terminable interest in the property, unless it specifically qualifies as qualified terminable interest property, or QTIP.
Okay, so terminable interest in QTI, that sounds like legal jargon that could easily trip someone up. Can you break down what a terminable interest is and then what makes something qualify as QTIP?
Great question, and yeah, it's a common point of confusion. A terminable interest is basically an interest in property that could end or fail upon, say, the lapse of time or if a specific event happens or doesn't happen. For instance, if you give your spouse a property, but with a condition that if they remarry, that property then goes to your kids, that's a terminable interest because their full ownership could terminate.
Oh.
Generally, these don't qualify for the marital deduction because the IRS wants to make sure the property will eventually be subject to estate tax in someone's estate, either yours or your spouse's.
Makes sense. So how does QT-type work around that?
Right. So to still qualify for the unlimited marital deduction as QTIP, even with a terminable interest, several strict conditions have to be met. First, your spouse, the done, must be entitled to all the income from that property for their lifetime, paid at least annually. Second, nobody else, only the done spouse, can receive any distributions of income or principal from that property during their lifetime. Third, the done spouse must have the right to require the property be made productive, generate income. And finally, the property must be subject to estate taxes upon the death of that surviving spouse.
Okay.
So essentially, the spouse has to have full, unfettered lifetime enjoyment and control over the income, and the value of that property must eventually be included in their estate for tax purposes when they pass away. It's really a way to ensure the wealth stays with the spouse for life, but it eventually gets taxed somewhere down the line. It's not a loophole, just a deferral mechanism.
That brings a lot of clarity to a pretty complex rule. It really makes sure the wealth is truly transferred to the spouse for their benefit, or it's taxed later as part of their estate. Let's walk through an example to make this marital deduction super clear, especially that after-marriage rule. Let's consider Casey and Pat.
Okay, good idea. So let's say Casey and Pat got engaged back in April of 2023. As an engagement gift, Casey gave Pat a diamond ring with a fair market value of $50,000. Later that year, after their wedding in July, Casey gave Pat $75,000 in cash, which Pat just deposited into an individual bank account. Assume both Casey and Pat are U.S. citizens. The question is, what was the amount of Casey's year 2023 marital deduction for gift tax purposes?
All right, let's figure it out.
The solution here is $75,000, and here's why. The rule, as we said, is that transfers between spouses aren't subject to gift tax or income tax. However, this unlimited marital deduction only applies to transfers made after the date of marriage.
Ah, the timing again.
Exactly. The $75,000 cash transfer was made in July after Casey and Pat were married, so it's fully eligible for the unlimited marital deduction. That means $75,000 of that transfer is completely exempt from gift tax. Now, the $50,000 ring, that was transferred in April before they were married. Therefore, it was not eligible for the marital deduction.
But the annual exclusion still applies.
It would be eligible for the annual gift tax exclusion, yes. For 2023, that exclusion is $17,000 per done. So only $33,000 of the ring's value, that's the $50,000 minus the $17,000, would count towards Casey's lifetime unified credit. This example really highlights that critical after date of marriage rule for the marital deduction. It's a very common planning error, actually, making a large gift right before the wedding and assuming it's covered.
Okay, so we've established some fantastic ways to give without triggering gift tax, leveraging those annual and unlimited exclusions. But the IRS, as you said, loves its details, and it's these fine points that can really make or break a gift's tax treatment. Two key concepts: present interest versus future interest, and complete versus incomplete gifts sound like they could significantly impact whether your gift actually qualifies for those exclusions or even for tax at all. This seems like where people can easily get tripped up.
That's exactly right. Understanding these distinctions isn't just academic. It's absolutely crucial for proper planning and, frankly, avoiding unintended tax consequences. Let's start with present versus future interest. As you mentioned, this is essentially about the timing. When does the done get to actually use or enjoy the gift? The core differentiator is whether there's a postponement of that right. If the right to use, possess, or enjoy the property is delayed, it's a future interest.
And why is that timing so incredibly important for our listeners? What's the practical impact?
The practical implication is enormous. A present interest gift is the only type that qualifies for that valuable annual exclusion we discussed, that's $17,000 per done, or $34,000 for married couples splitting gifts. It also generally ensures the gifted property is effectively removed from your estate for estate tax purposes. However, a future interest gift, or even a present interest gift where the immediate value isn't clearly ascertainable, does not qualify for the annual exclusion. This is a very common pitfall. If you make a gift of a future interest, you're typically required to file a gift tax return that's Form 709, regardless of the amount, because you simply cannot use that $17,000 annual exclusion to offset it. It immediately starts eating into your lifetime unified credit.
So what would be an everyday example of a future interest gift that a listener might encounter without realizing it? Maybe setting up a trust.
Good question. Yes, trusts are a common area. One scenario is setting up a trust where the income or principal is only distributed to the beneficiary at some future time, like when they turn 30, or maybe after another person, say their parent, passes away. Let's look at some specific examples. Reversions. This is when you gift assets, but you, the donor, keep the right to get the property back at some point. For example, putting money in trust for your grandchild, but stating if they don't graduate college by 25, the rest comes back to you. Their interest is limited, and your right to get it back makes their full enjoyment uncertain. That's a future interest. Remainders. Here, property goes to the donor only at some future time. Imagine a trust where your sister gets income from property for life, but after she passes, the main assets, the remainder, go to your niece. Your niece's interest in those main assets is a future interest because her enjoyment is delayed until your sister's death. Trust income interests. Also, if a trust requires or allows the trustee to accumulate income, and that accumulated income is only distributed later, that's usually a future interest. If the beneficiary doesn't have an immediate unconditional right to demand that income, it generally counts as future. Trust income interests. And finally, present interests without an ascertainable value. Basically, if you can't clearly put a dollar value on the immediate right to the gift, like just a general promise to give something later, that won't qualify either.
That makes the future interest concept much clearer. It's really all about delayed or uncertain enjoyment. So, flipping that, what about the types of present interest gifts that do qualify for that valuable annual exclusion?
Present interest gifts are usually more straightforward. They include things like outright gifts of cash or property. Simple, direct, immediately available. This is the most common and easiest way to use the annual exclusion. Trust income interests with mandatory distribution. If a trust mandates that income must be distributed to the beneficiary annually or even more frequently, that immediate and unconditional right makes it a present interest. Life estates, where someone gets the immediate right to use and possess property right now, even if they don't own the underlying property outright. For example, giving your parent the right to live in your vacation home for their lifetime, starting immediately. Estates for a term certain. Similar to a life estate, but for a defined period, like giving someone the right to use a property for exactly 5 years. Bonds or notes. Even if the interest isn't actually paid until maturity, the right to the bond itself is immediate. Unrestricted transfers of life insurance policies. If you gift a life insurance policy and the done immediately has full control, they can cash it in, change beneficiaries, whatever. That's a present interest. The key for all of these is immediate and ascertainable enjoyment or control by the person receiving the gift.
Okay, so beyond when the gift can be enjoyed, it also really matters whether the gift is truly done and dusted in the eyes of the law. This leads us to complete versus incomplete gifts. This sounds like another area with potential traps.
It absolutely is. Only complete gifts are subject to gift tax, and crucially, only complete gifts qualify for that valuable annual gift tax exclusion. The completeness test really revolves entirely around whether the donor, that's you, has genuinely and irrevocably given up all control over the gifted property. A gift is considered complete and therefore subject to gift tax, even if the done isn't born yet, as long as their identity can be clearly figured out later. It's also considered complete even if there's a possibility the property might theoretically revert back to the donor at some distant future time, as long as the donor has given up their current dominion and control.
So when is a gift considered not complete? Meaning it's not taxable yet.
A gift is not considered complete, and therefore not subject to gift tax yet if it is either conditional or revocable. Conditional gifts. These are gifts subject to what's called a condition precedent, meaning they won't actually be provided until a specific event or condition is met. For instance, if you tell your niece, I'll give you $50,000 only if you graduate from a 4-year accredited college by age 22, until she actually graduates and fulfills that condition, the gift isn't complete. It's not a taxable gift yet because it's still sort of within your control. The condition might never be met. Revocable gifts. This is when the donor explicitly reserves the right to revoke the gift or maybe change who the beneficiaries are. For example, if you put money into a trust for your child but explicitly keep the power to take that money back or to change who ultimately gets it, it's not a completed gift. The gift only becomes complete when those rights end for a reason other than your death, like if you later decide to formally give up that power of revocation. The core idea is if you can still pull the strings, the gift isn't really done.
Got it. Now, a quick but absolutely crucial point here because it's a common misunderstanding. What about the person receiving the gift? Do they have to worry about paying tax on it?
That's important for the recipient to know, and it's a significant relief for many. They pay no gift tax whatsoever. The federal gift tax is solely the responsibility of the donor, the person making the gift.
Okay.
Furthermore, and this is another key insight, the gift itself does not represent taxable income to the recipient. So, if your grandmother gives you a $100,000 gift, you don't report that as income on your personal tax return.
That's good news for recipients.
It is. However, there is a nuance regarding the recipient's basis in gifted property, which comes up if they later sell that property. Generally, for income tax purposes, the recipient's basis is the same as the donor's basis, plus any gift tax the donor paid that's attributable to the appreciation in the gift's value. We'll definitely dig into that specific detail more when we talk about non-cash assets, but for now, the key takeaway is clear. For the recipient, no gift tax and no income tax just from receiving the gift.
Now, let's try to put all these rules together and see how they actually play out in real-world calculations. This is where you can truly see the immediate, tangible impact of smart planning, especially around those annual exclusions and that powerful strategy of gift splitting. Theory meets practice, right?
Exactly. This is where the financial strategy becomes tangible. To calculate your taxable gifts for the year, you basically start with the aggregate fair market value, FMV, of all gifts you made during that calendar year. From that total, you then subtract all the applicable annual exclusions, that's $17,000 per done, or $34,000 if you're married and elect to split gifts, any unlimited marital deductions for gifts made to your spouse, and any unlimited charitable gifts. And it's important to remember, the amount of any non-cash property gifts like stocks, real estate, artwork is always valued at its fair market value on the precise date you make the gift.
Let's use a very practical example to illustrate this. Let's look at Jack Smith's gifts.
Okay, sounds good. So between January 1st and March 31st, 2023, Jack Smith, who's a diligent planner, made the following gifts. He gave $20,000 in cash to his friend Adele. He gave a sculpture valued at $4,000 to his nephew, Barry. Jack had bought this sculpture 3 years ago for $2,500, and he also gave 100 shares of Zorro Corp. Common stock, valued at $400 per share at the time, to his daughter, Christine. Jack had purchased this Zorro stock just 6 months ago for $425 per share. Let's assume Jack made no other gifts during the year.
Okay, first let's look at Jack as a single taxpayer. How do his gifts break down for tax purposes?
All right, if Jack is single, we apply that $17,000 annual exclusion per dunny. For Adele, Jack gave her $20,000 cash. Since the annual exclusion is $17,000, $3,000 of that gift is taxable, $17,000. For Barry, Jack gave him a sculpture valued at $4,000. This is less than the $17,000 annual exclusion, so $0 of this gift is taxable. Doesn't matter what he paid for it or how long he held it for gift tax value, only its fair market value on the gift date matters. For Christine, Jack gave her Zorro stock valued at $40,000. That's 100 shares, that's $400. Applying the $17,000 annual exclusion, $23,000 of this gift is taxable, $40,000 and $2,000. So if Jack is single, his total taxable gifts for the year would be the sum of those taxable parts, $3,000 for Adele, plus $0 for Barry, plus $23,000 for Christine, a total of $26,000.
Does he owe tax on that $26,000?
Well, Jack would only owe actual gift tax if this $26,000, when added to all his prior cumulative taxable gifts over his lifetime, exceeds his big unified lifetime exclusion of $12,920,000. However, and this is important because at least one of his gifts to Adele and Christine exceeded the annual per done exclusion amount, Jack must file a gift tax return, Form 709, for the year, even if he doesn't actually owe any tax yet because he still has plenty of lifetime exclusion left. That filing requirement is key.
That makes perfect sense. Now let's really demonstrate the sheer power of gift splitting. What if Jack is married and he and his spouse elect to split gifts for 2023? How does that change the calculation?
This is where the strategic impact for married couples really becomes apparent. With gift splitting, that available annual exclusion effectively doubles to $34,000 per done. Let's recalculate. For Adele, Jack gave her $20,000, but now, with the $34,000 gift splitting exclusion available, $20,000 is less than $34,000. So $0 of this gift is taxable. That's a huge difference from the single scenario. For Barry, Jack gave him the $4,000 sculpture. Still way less than $34,000, so $0 is taxable. No change there. For Christine, Jack gave her $40,000 in Zorro stock. With the $34,000 gift splitting exclusion, the taxable amount is drastically reduced. It's just $6,000, $40,000, $34,000. So if Jack is married and elects to split gifts, his total taxable gifts for the year drop dramatically from $26,000 all the way down to just $6,000. This clearly demonstrates the immense tax-saving power and efficiency of using that gift-splitting election for married couples. It lets you transfer a much larger amount of wealth tax-free each year by leveraging both spouses' annual exclusions. And it significantly cuts down the amount that eats into your lifetime unified credit. It's really an essential strategy for long-term family wealth transfer.
That example truly shows the immediate, tangible power of strategic planning. It's not just about knowing the rules, but actively applying them. Okay, but what about those unlimited exclusions we talked about earlier, direct payments for tuition, medical care, charitable gifts? How do they factor into a mixed bag of giving, which is often what real life looks like? It's rarely just one type of gift, right?
You're absolutely right. Real-world giving is often a combination of different types of support. And this is where careful planning and knowing exactly which exclusions apply to which payment truly comes into play to minimize your taxable gifts. Let's look at Jill. She's a single taxpayer, and she made several different gifts totaling $100,000 during the current year. This example should beautifully illustrate how multiple exclusion types interact. First, Jill gave $20,000 to the library building fund for City Community College. Okay, assuming the college is a public charity, this gift qualifies for the unlimited charitable exclusion. So for gift tax purposes, $0 of this $20,000 is considered a taxable gift. It's a gift that does good and doesn't count against her lifetime exclusion at all. Second, she gave $20,000 directly to City Community College specifically for her granddaughter Izzy's tuition. As we detailed earlier, amounts paid directly to an educational organization for tuition get that unlimited educational exclusion. So again, $0 of this $20,000 is a taxable gift. Incredibly powerful, tax-free way to support education costs. Third, Jill gave $20,000 directly to her granddaughter Izzy to help pay her living expenses while she attends college. Now, here's where the distinction from the tuition payment is crucial. Unlike tuition paid directly to the school, living expenses or other funds given directly to the student are not covered by that unlimited educational exclusion.
Oh, okay. So this is a taxable gift, but it is eligible for the annual $17,000 per done exclusion. Therefore, only $3,000 of this gift, $20,000 minus the $17,000 annual exclusion, is considered a taxable gift. This is a common trap for well-meaning grandparents. Fourth, she gave $20,000 directly to City Hospital to help pay for her friend Jack's surgery. Similar to the tuition payment, fees paid directly to a healthcare provider for medical care get that unlimited medical exclusion. So $0 of this $20,000 is a taxable gift. Again, fantastic way to provide substantial support for medical needs without gift tax implications. Finally, Jill gave $20,000 directly to her friend Jack to help him pay for home care after his surgery. Just like Izzy's living expenses, this is not a direct payment to a healthcare provider for medical care. It's money given to Jack. So this is a taxable gift, but it's eligible for the annual $17,000 per done exclusion. This means only $3,000 of this gift, $20,000 minus the $17,000 annual exclusion, is a taxable gift.
That's a perfect breakdown.
Right.
So when all is said and done, after applying all those different rules and exclusions, what's Jill's total taxable gift amount for the year? Okay, after meticulously applying all those rules, Jill's total taxable gifts for the year would be the sum of just the taxable portions. That's $3,000 from Izzy's living expenses, plus $3,000 from Jack's home care. That brings her total taxable gifts to just $6,000.
Only $6,000 out of $100,000 given.
Exactly. This example beautifully illustrates how different types of gifts interact with various exclusions to minimize your gift tax liability, often far more than people realize is possible. It really highlights the profound importance of how and to whom the payment is made. It's a testament to how knowing these rules can truly allow your generosity to go much, much further from a tax perspective.
That makes it incredibly clear and really showcases the strategic nuances. So just to recap for everyone listening, to make absolutely sure your gift qualifies for that valuable annual exclusion, which is such a cornerstone tool for annual wealth transfer, there's a pretty straightforward checklist to keep in mind, right?
Yes, absolutely. To maximize the use of that annual $17,000 or $34,000 with gift splitting exclusion, your gift really must meet three key criteria. One, it must be a present interest. Like we discussed, the donor needs the immediate, unrestricted right to use, possess, or enjoy the property. No strings attached, no delayed gratification for tax purposes. Two, it must be complete. You, the donor, must have given up all dominion and control over the property. If you can still take it back, it's not complete yet. Three, and the amount must be under the annual dollar limit per done. That's the general rule. Unless, of course, the gift falls into one of those incredibly powerful unlimited exclusion categories we just covered, like direct payments for medical, educational tuition paid directly to the institution, or gifts to qualified charities. If you fail any of these criteria for a gift that isn't in an unlimited category, you'll likely use up some of your lifetime exclusion and potentially trigger that gift tax return filing requirement. And Just to connect this to the broader financial picture, once you've carefully calculated your total taxable gifts for the current year, the actual federal gift tax you might owe is determined by a cumulative process. You add this year's taxable gifts to all the taxable gifts you've made in prior years. That gives you your cumulative lifetime gifts. Right.
You then apply the progressive gift tax rates to that cumulative amount, subtract any gift tax you actually paid on prior gifts, and finally, you subtract your unified credit. Remember that big credit tied to the $12,920,000 exclusion amount for 2023. The result is the tax due, if any, on your current gifts. It's a cumulative system, meaning every dollar you gift beyond those exclusions counts toward that one big lifetime exclusion bucket. This is precisely why annual strategic gifting using the exclusion is so valuable. It preserves that large lifetime credit for potentially massive transfers later on, like in your estate plan.
Okay, moving beyond cash, which is relatively straightforward, what happens when you want to gift non-cash property? Things like highly appreciated stocks, maybe family real estate, or even valuable artwork. There seem to be some powerful advantages here for minimizing your future estate, but also some crucial nuances for the recipient that are often overlooked, creating a sort of hidden trade-off. That's an excellent point, and it's really a cornerstone of more sophisticated wealth transfer planning. One of the primary advantages of transferring non-cash property to other individuals as gifts during your lifetime, rather than waiting until death, is definitely the availability of that annual per done gift tax exclusion. As we've emphasized, that $17,000 per done or $34,000 for married couples splitting gifts is only available for gifts made during your lifetime. Property transferred at death simply doesn't get the benefit of this annual exclusion. And remember, for gift tax purposes, non-cash property is always valued at its fair market value, FMV, on the date you make the gift. So you can effectively move up to $17,000 or $34,000 worth of assets out of your estate each year per person, completely free of any transfer tax. This is a significant incentive for proactive, systematic wealth transfer over many years.
But this is where that critical point comes in, the one many people overlook that can lead to unintended consequences for the recipient. While gifting appreciated property might save your estate tax down the line, it can create a very different income tax scenario for the person receiving it, especially when they eventually sell that asset. This is that hidden trade-off we need to explore.
You've hit on a crucial distinction for overall family tax planning. When you gift appreciated non-cash property during your lifetime, let's say stocks that have soared in value since you bought them, the done recipient's basis in that property for income tax purposes is generally the same as your basis as the donor.
Okay, so they inherit my cost basis.
Exactly. It's often called a carryover basis. For instance, if you originally bought stock for $10 a share and it's now worth $100 a share when you gift it, your done's basis is still that original $10. This means all the appreciation that occurred while you owned it up to the point of the gift will be recognized as a taxable capital gain by the done when they eventually sell the property. This could lead to a future income tax liability for them, something many donors just don't consider.
But that's fundamentally different if they inherit the same property after your passing, right? That's where the famous step-up in basis comes into play.
Yes, and this is the significant contrast and a truly powerful tool in estate planning. For property that is inherited, the recipient's basis is stepped up or sometimes stepped down if it lost value to the fair market value, FMV, at the date of death of the decedent, or an alternate valuation date if elected.
Stepped up, okay.
This is known as a step up in basis. What this means in practice is that all the appreciation in value of the property that occurred during the decedent's lifetime is effectively never subject to income tax if that property is transferred at death. The beneficiary receives the asset with a new, higher basis equal to its value on the day the original owner passed away. This often eliminates capital gains tax on all the appreciation that happened before death. So, using that same example, if that $10 stock was worth $100 when you died, the heir's basis becomes $100. They could sell it the next day for $100 with potentially zero capital gains tax.
So if I'm understanding this critical planning insight correctly, gifting appreciated property during your lifetime avoids transfer tax on future appreciation. Any value it gains after you gift it is out of your estate. But transferring it at death avoids income tax on all appreciation that occurred up to the date of death because of the step-up. That's a significant strategic decision point.
Precisely. This requires really careful consideration. If an asset has significantly appreciated and maybe you expect the DUN to sell it relatively soon after receiving it, transferring it at death might actually be more tax efficient for the DUN because of that step up in basis. They avoid potentially large capital gains tax. However, if your primary goal is to remove potential future appreciation from your estate, maybe you think the asset will grow much more, or if the DUN plans to hold the asset for a very long time, then a lifetime gift using that annual exclusion might be preferable for your estate planning goals. It's a strategic trade-off. It really depends heavily on the specific asset, its appreciation potential, your overall estate size, and importantly, the DUN's intentions for the asset. This is definitely where talking with a financial planner or tax advisor can be invaluable.
Absolutely. Okay, now let's turn our attention to charitable giving. Beyond, the immense good it does in the world, strategic charitable donations, especially of non-cash property, offer some incredible opportunities to reduce your taxable income and also your estate. This really sounds like one of those rare win-win scenarios in the tax code.
It absolutely is, and it's a cornerstone of effective financial planning for anyone with philanthropic goals. The foundation, the very first step for receiving an income tax deduction for a charitable donation, is that the organization must be recognized by the IRS as a Section 501c3 organization. These are generally your public charities, churches, schools, hospitals, most well-known charities you'd think of, as well as private foundations. Once you've confirmed the charity's status, the tax treatment and the amount of your deduction depend heavily on the type of property you contribute. We primarily classify non-cash property for charitable contributions into two main types: ordinary income property and long-term capital gain, LTCG property. For ordinary income property, the deduction you can take is limited to the lesser of the property's adjusted basis. That's generally what you paid for it. Maybe adjusted for depreciation or its fair market value, FMV, at the time you contribute it.
Lesser of cost or value.
Right. This rule typically applies to things like inventory, if you own a business. Assets you've held for 1 year or less, short-term assets, which if you sold them would generate ordinary income. Investment or personal use assets that have actually depreciated in value since you acquired them. Or the portion of gain on long-term business assets that represents depreciation recapture. So if you bought a piece of furniture for $1,000 and it's now only worth $400 when you donate it, your deduction would be capped at $400, even though your basis was higher.
That's a key distinction right there. Deducting the lesser amount makes sense if the item lost value. But then there's long-term capital gain property, which generally offers a much bigger incentive, right? This sounds like where the real magic happens.
Yes. For long-term capital gain, LTCG property, which is basically appreciated capital gain property you've held for more than 1 year, the rule is generally much, much more favorable. The amount of your deduction is usually its full fair market value at the time of the contribution.
The full market value, wow.
Yes, the full FMV. This is a powerful benefit because you get a deduction for the full appreciated value without having to pay capital gains tax on that appreciation yourself. This typically applies to things like appreciated investment assets held over a year, like stocks, mutual funds, or real estate; personal use assets that have appreciated and been held over a year, maybe a valuable stamp collection or artwork; or the gain in excess of ordinary income depreciation recapture for long-term business assets. This is where the real tax efficiency comes in for charitable, giving you often get a double benefit, a deduction for the full value, and you avoid paying capital gains tax on the appreciation. It's a very popular strategy, especially with appreciated stock.
Even with those generous rules for LTCG property, it's not always as simple as just taking the fair market value. There are a couple of specific rules I understand that can significantly limit your deduction, even for appreciated property. So you really need to be aware of them to avoid deduction traps and maximize your giving impact.
Absolutely. One critical special rule applies to tangible personal property put to unrelated use. Okay, what does that mean? If you donate LTCG tangible personal property, think valuable art, antique furniture, collectibles, to a charitable organization, and that organization then uses the property for a purpose unrelated to its actual charitable mission, your deduction gets limited.
Unrelated use. How does that work?
Instead of getting the full fair market value, your deduction gets capped at your adjusted basis in the property, basically, what you paid for it. For example, let's say you donate a valuable painting you bought years ago for $10,000 and it's now worth $50,000 to a local museum. If the museum displays the painting as part of its collection or uses it for educational purposes, that's related use, and you likely get the full $50,000 deduction. But if the museum instead immediately sells the painting to raise general funds, That sale is typically considered an unrelated use. In that specific scenario, even though the painting had significantly appreciated, your deduction would be limited back down to your original cost, just $10,000.
Wow, that's a huge potential trap.
It is. It's a critical detail that can cost a donor a lot in deductions if they're not aware of the charity's intended use for the specific item.
Okay, what about cars or other vehicles? There are often specific rules around those too, aren't there? People donate cars all the time.
There absolutely are. There's a specific rule for the donation of a qualified vehicle sold by charity. Now, a personal use vehicle, car, truck, boat, airplane typically depreciates, right? It loses value over time. So when you donate it, its fair market value is usually less than what you originally paid, your adjusted basis. This means it generally falls under the ordinary income property rules anyway, where your deduction is limited to the lower FMV. However, if the charitable organization subsequently sells that vehicle, your deduction is often further limited based on the actual sale price. If the fair market value when you donated it was more than $500, your deduction is limited to the lesser of the gross proceeds the charity got from selling the vehicle, or the fair market value on the date you contributed it, assuming FMV is less than your basis, which it usually is for cars.
Okay, so it ties to what the charity actually gets for it.
Pretty much. If the charity sells the vehicle for $500 or less, your deduction is limited to the lesser of $500, or the fair market value on the contribution date. This rule is really designed to prevent people from claiming inflated values for donated vehicles and ensures your deduction more closely aligns with the actual financial benefit the charity receives from your donation.
Got it. Let's run through a comprehensive example now to tie all these non-cash property nuances together, especially that tricky unrelated use rule. Let's say Bill Sanders bought an oil painting for $25,000 5 years ago. Now a museum wants it. How does this deduction work in two different value scenarios? And crucially, what if the museum decides to sell it instead of displaying it?
Okay, this is an excellent way to illustrate these points clearly. Scenario 1. The painting's current fair market value, FMV, is $20,000. Since Bill purchased it for $25,000, the painting has actually depreciated in value. Even though he's held it for more than a year, because its value is less than his basis, it's considered ordinary income property for deduction purposes. The amount of his charitable contribution deduction will be the lesser of its adjusted basis, $25,000, or its FMV at the time of contribution, $20,000. So Bill's deduction here is $20,000. This is a common situation for items that lose value over time. Scenario 2. The painting's current FMV is $30,000. Okay, now the painting has appreciated in value, $30,000 FMV versus $25,000 purchase price. Since it's a capital asset held for more than 1 year and it has appreciated, it's considered long-term capital gain LTCG property. In this case, assuming the museum will use it for related purpose, like displaying it, the deduction will generally be the full $30,000 FMV at the time of the contribution. This is the ideal scenario for a donor, full deduction for the appreciated value, no capital gains tax recognized.
Now, for that crucial unrelated use note you mentioned, what if, in that second scenario where the painting is worth $30,000, the museum decided, you know what, we need cash more, and they sold the painting instead of displaying it? How does that impact Bill's deduction?
This is exactly where that unrelated use rule bites hard. If the museum, instead of displaying the painting in its main lobby or using it for its charitable purpose, sold the painting, then Bill's deduction would be limited back down to his adjusted basis in the painting, which was $25,000.
Even though it was worth $30,000?
Even though its fair market value was $30,000. The reason is that selling the painting would be considered an unrelated use of that tangible personal property by the charity. So for you, the listener, the takeaway is, if you're donating valuable art, collectibles, or other tangible personal property, it's incredibly wise to have a clear understanding, maybe even in writing, that the charity genuinely intends to use it directly for its mission, display it, teach with it, incorporate it into programs, and not just immediately liquidate it for cash. Otherwise, your generous deduction, which you thought was based on the appreciated value, could be unexpectedly capped at your original cost. It's a critical detail for maximizing your tax benefit from these kinds of donations.
That's a perfect illustration of how subtle details can have a huge financial impact. Okay, so even with all these rules for determining the amount of your potential deduction, there's still limits, right? Limits on how much you can actually deduct in a single year based on your adjusted gross income or AGI. But the good news is, savvy planning allows you to carry over excess deductions so that generosity isn't truly lost from a tax perspective. This seems like where you can really maximize multi-year tax savings from major charitable contributions.
That's a vital point for long-term giving strategies. You're right, the maximum allowable income tax deduction for charitable contributions in any given year is capped, and it depends on two main factors: the type of property contributed, cash, ordinary income property, or LTCG property, and the type of charity receiving it, public charities, private operating foundations, or private non-operating foundations.
Could you maybe quickly clarify the difference between those private foundations again for us, operating versus non-operating?
Sure. A private operating foundation is basically a private foundation that actively carries out its own charitable activities. Think of a private museum using its endowment to operate its facility, or a private research organization doing its own research. They're more hands-on with their charitable work. A private non-operating foundation, on the other hand, typically doesn't run its own programs. It primarily distributes funds to other charitable organizations. They essentially act as grant-making entities, giving money away rather than running direct services.
Got it. So the AGI limits differ based on who gets the gift.
Yes, and the limits are generally more generous for contributions to public charities and those private operating foundations compared to the private non-operating ones. The IRS generally prefers donations that support direct public engagement or active charitable work. For example, cash contributions to public charities and private operating foundations are limited to 60% of your AGI for the year. But cash given to private non-operating foundations, that's usually limited to 30% of AGI. For ordinary income property, it's generally a 50% AGI limit for public charities and private operating foundations, but only 30% for private non-operating foundations. And for that valuable LTCG property, the cap is usually 30% of AGI for public charities and private operating foundations, but only 20% for private non-operating foundations. Now, what's also critically important for your tax planning is the order in which these AGI limitations are applied if you have multiple types of contributions in one year. You don't just pick and choose. You must apply the limits in a specific sequence. 1, first, to cash contributions, subject to that 60% limit. 2, then to ordinary income property contributions, subject to the overall 50% limit, considering the cash already deducted. 3, and finally to LTCG property contributions, subject to the overall 30% limit, again considering what's already been deducted. This specific ordering can significantly affect how much of each type or contribution you can actually deduct in a given year, and importantly, how much might need to be carried over to future years.
This sounds like the big one. Our final example, I believe, combines cash, ordinary income property, and LTCG property to show exactly how all these AGI limits and ordering rules work together to determine your actual deduction for the year. This is where it all comes together for truly strategic charitable giving and maximizing those multi-year tax benefits. Let's look at Joe Kelly's situation.
Okay, Joe Kelly is an individual taxpayer who itemizes his deductions, and his adjusted gross income, AGI, for the year is $100,000. He made 3 distinct charitable contributions during the year, all to public charities. First, he made a $15,000 cash contribution to the United Way. Second, he donated some personal furniture to Goodwill. He had originally bought this furniture for $25,000 3 years ago, but its fair market value, FMV, on the date he contributed it is only $10,000. Third, he donated a sculpture to the art museum. He had purchased this sculpture for $20,000 5 years ago, and its FMV on the date of contribution is $30,000. Now let's calculate his total allowable charitable contributions deduction for the year, step by step, following those important ordering rules. First, we address the cash contribution to United Way. The $15,000 cash contribution to United Way, a public charity, is subject to the 60% of AGI limitation. 1. Joe's 60% AGI limit is $100,000 AGI times 60%, which is $60,000. His cash contribution was $15,000. 3. The allowable deduction for this cash contribution is the lesser of the limit, $60,000, or the actual contribution, $15,000. So he can deduct the full $15,000. This uses up $15,000 of his overall 60% and 50% AGI limits. Next, we move to the ordinary income property, Goodwill furniture. The personal furniture contributed to Goodwill, a public charity, has depreciated, cost $25K, FMV $10. Therefore, as we learned, it's treated as ordinary income property. The amount of the contribution for deduction purposes is the lesser of its cost basis, or its FMV, which is $10,000. This contribution is subject to the 50% of AGI limitation. 1. The base 50% AGI limit is $100,000 AGI times 50%, which equals $50,000 too. Now, crucially, from this $50,000 limit, we must first subtract the cash contribution already allowed, $15,000, because cash is applied first according to the ordering rules. This leaves a remaining 50% AGI limit specifically for other contributions of $35,000, $50,000. 3. His contribution of ordinary income property, the furniture, is valued at $10,000 for deduction purposes. 4. The allowable deduction for this ordinary income property is the lesser of the remaining limit, $35,000, or the actual contribution amount, $10,000. So he can deduct the full $10,000 for the furniture. This uses up another $10,000 of his overall 50% AGI limit. Finally, we address the LTCG property art museum sculpture. The sculpture contributed to the art museum, a public charity, is a long-term asset that has appreciated. Cost $20, FMV $30. So it's LTCG property. Assuming related use by the museum, the amount of the contribution for deduction purposes is its FMV, which is $30,000. This type of contribution is subject to the 30% of AGI limitation. First, let's calculate the direct 30% AGI limit specifically for this type of property. $100,000 AGI times 30% equals $30,000. First, let's calculate the direct 30% AGI limit specifically for this type of property. 2. Next, we also need to consider how much of the overall 50% AGI limit still remains after we account for the cash, $15, and the ordinary income property, 10 LT contributions. The total 50% AGI limit was $50,000. We've already utilized $15,000 for cash and $10,000 for ordinary income property. So $50,000 minus $15,000 minus $10,000 leaves $25,000 remaining under the overall 50% AGI umbrella. 3. Now, the allowable deduction for LTCG property is limited to the lesser of these two calculated amounts, the specific 30% AGI limit, $30,000, or the remaining overall 50% AGI limit, $25,000.
Wow. Okay, the lesser of those two.
Exactly. The lesser of $30,000 and $25,000 is $25,000. Therefore, Joe's deduction for the sculpture in the current year is limited to $25,000.
Wow, okay, so he contributed $30,000 worth of sculpture, a very generous gift. But because of these interacting AGI limits and the specific ordering rules, he only gets to actually deduct $25,000 on this year's tax return. What happens to the remaining $5,000? Is it just lost? That seems unfair.
This brings us to one of the most powerful and honestly often overlooked tax-saving benefits built into charitable giving.
No.
Carry forward. No, that $5,000 is absolutely not lost. First, let's just sum up Joe's total allowable charitable contribution deduction for the current year. Cash, $15,000. Ordinary income property, $10,000. LTCG property, $25,000. Add those up, and his total charitable contribution deduction for the year equal $50,000. Now, regarding that remaining $5,000 from the sculpture contribution, Joe contributed $30,000 worth of sculpture, but was only allowed to deduct $25,000 in the current year due to those AGI limitations. $30,000 contributed, $25,000 deducted equals $5,000 excess. This remaining $5,000 becomes a charitable contribution carry forward.
Carry forward. Okay, how does that work?
This $5,000 can be carried forward for up to 5 years, and it's applied on a first-in, first-out FIFO basis. This means in the next year, year 2, this $5,000 carry-forward amount gets used before any new LTCG property contributions Joe might make in year 2, subject, of course, to the AGI percentage limitations of year 2. This is a critical strategy for maximizing your tax savings over multiple years, especially if you make large donations that might exceed your annual AGI limits. It ensures that your generosity continues to provide tax benefits in the years to come. It's not lost, just deferred. So just to reiterate that point, that 5-year carryover rule applied first in, first out is your assurance that your generosity, even if it bumps up against your AGI limits in 1 year, can continue to provide substantial tax benefits in future years. It's a really powerful mechanism for long-term tax planning, allowing you to give big when you want to and still potentially get the full deduction over time. And finally, just a quick but essential practical note on substantiation requirements, the paperwork. For non-cash contributions over $500, you generally must file Form 8283 with your tax return, providing specific information about the gift and the charity. And if you're claiming a deduction of more than $5,000 for any single item or a group of similar items, think like a valuable stamp collection or that single piece of art, you'll generally need a qualified written appraisal for each such item or group. There's an important exception for publicly traded securities, which usually don't require an appraisal, but for most other valuable non-cash items, that appraisal and detailed documentation are absolutely essential to support your deductions if the IRS ever asks. So keep meticulous records of your giving.
Wow, we have covered a tremendous amount of ground today, really, from the fundamental annual and unlimited gift tax exclusions that provide these incredible avenues to transfer wealth tax-free, to the really nuanced strategies of gifting appreciated non-cash assets, thinking about those hidden basis considerations for the recipient, and then the truly powerful income tax deductions available through strategic charitable contributions, especially understanding those critical AGI limits and the incredible power of the carryovers. We've really shown how every detail, from who you pay to what you give, can completely swing your tax outcome.
It's truly fascinating, isn't it? How deliberate, well-informed planning can transform acts of generosity into significant tax efficiency. Whether it's gifting to family members to support their education or cover medical needs, or making impactful contributions to the causes you care deeply about, understanding these often intricate rules means your good intentions can translate into maximum financial impact, both for the recipient and for your own financial well-being. And this really raises an important question for you, our listener, to think about. How might you adjust your own gifting and charitable giving strategy this year, or maybe in the years to come, to truly leverage these powerful tax-saving opportunities we've just unpacked? Are there things you're doing now that could be structured differently for a better tax result?
Think about it. The insights we've unpacked today aren't just about compliance, filling out forms correctly. They're really about empowering you to make choices that perfectly align your values with smart, strategic financial outcomes. They're about being a savvy giver, maximizing the impact of your generosity. Thank you so much for joining us on this deep dive into the strategic secrets of giving. Until next time, keep learning, keep growing, and definitely keep asking those insightful questions that lead to better financial decisions.